Perfect. Well, thank you for joining the Director's Cut March 15th. I don't think I have any other housekeeping updates. We did post a fact sheet to the website. So if you go to the Oil and Gas Division's website, to the Information Center, you'll see that linked there just with some of the latest production. So we'll keep that up to date with the Director's Cut as well. Otherwise, I'll hand it over to Lynn.
Hey, thanks, Katie. And thanks everyone for dialing in or showing up for Director's Cut. We're talking January production, and we're off to a good start for 2019. Pretty much a photo finish with December of 18. Actually, production is higher than what the December preliminary numbers were, but a little bit, few corrections, and it turns out that December's final production is just slightly high, like 300 barrels a day to January. So that's why I called it a photo finish, but we're off to a really good start, good strong start, over 1.4 million barrels a day. Surprisingly, gas production up significantly, new all-time high, up 69 million cubic feet a day, 2.6%. So again, we're back to that pattern where gas is increasing much faster than crude oil, and putting pressure on the gas gathering and processing. And we'll talk about gas capture in just a minute. Some other good news, you can see that oil prices, North Dakota Light Sweet is up $25 a barrel from December, so to today. And again, that goes back to what was going on in December. We had a lot of refining in PADD 2 shut down. That's where crude oil goes. That was impacting Canadian prices, impacting North Dakota prices at Clearbrook, and really dragging the value of a North Dakota barrel down. But even on that, West Texas Intermediate prices are up $10 from December to today. Rig count has remained steady. So again, winterized rigs, the terrible weather just really doesn't bother the drilling rigs that much anymore. Companies are still proposing that they're going to move by the end of the year to probably around 70 drilling rigs from the 65 that they're at, especially with the strengthening in crude oil prices. So we're anticipating small incremental rig adds as the year goes on. When we talk about Fort Berthold, a lot of variation. We've been seeing a lot of ups and downs in activity on Fort Berthold over the last few months. And I attribute most of that to the uncertainty about the oil tax sharing agreement. But that is on track now. I know the agreement has been signed. I believe it has passed one house of the legislature. And so that should really stabilize activity on Fort Berthold. But it really has been up and down a lot. Month to month, changes of 3, 4, 5 drilling rigs, mostly on the trust lands, production up, production down. I think that's going to stabilize as we move forward with that tax sharing agreement. There just was too much uncertainty for oil companies, and they were doing what they had to do, but no more. When we move into completions, you can really see the impact of winter weather starting to set in. Only 79 wells completed in January. That's probably why it was a flat month. They were good wells, but only 79 wells completed. And you can see the wells waiting on completion rising. So even though the rig count has remained flat or stable, frac crews were let go and furloughed, and so completion activity down. We're going to see that non-completed well inventory build over the remainder of the winter, and probably until load restrictions come off, which could be quite late this year. A lot of wet snow, and there's going to be soft roads, although as we were discussing before we went online here, the big storms have missed the oil patch primarily, and so maybe the impacts will be a little bit less than what we would think sitting here in Bismarck or in the eastern part of the state. One interesting fact is that rig activity on the grasslands has been increasing. And so we're starting to see the merger and acquisition activity of those leases transferring to like NP Resources and companies like that. They've capitalized, they've put their drilling plan together, and they're starting to act on that. And so we actually have 5 rigs out of the 65 that are running on federal lands, grasslands. So that's kind of encouraging. You know, there's some very good geology out there and a lot of land, and it was lagging in terms of development. I want to mention seismic. We have 4 surveys, and I realize that's not a lot, but there's one that's extremely exciting to us, and that's the Red Trail Energy carbon capture project. And so that's underway right now in Richardton. It's an exciting project. To the best of my knowledge, it is the first ethanol plant in the United States that plans to capture its CO2 emissions and store them geologically. And so that project will be progressing through the summer, and we'll keep you posted on it. Right now, they're shooting 3D seismic over a large area southeast of the city of Richardson. And then the next stage will be to drill a well and actually take a look at the Broom Creek formation there, and then probably drill a monitoring well. And hopefully by early next year, there will actually be carbon being captured and stored at Red Trail. So that's exciting for us. And we're going to get a good image of what the Broom Creek formation looks like around Richardson from this 3D seismic survey. The weather is causing some struggles. Very, very difficult time to lay out geophone lines and do your seismic survey, but snow is really beneficial to that because it quiets everything down, and you get a really good sound sample, good image of the subsurface. But so I wanted to mention, you know, something very different and exciting in the seismic arena. Talking about gas capture, good news there too. Production, as I stated, gas production went up 69 million, capture went up 78 million. So 2.6% more production, 3.6% more capture. That's great news, and it moved us just marginally towards our goal. Predominantly, that's because the Wild Basin plant is up and able to process at full capacity. It is not full, and so they are shopping around looking for gas that could be offloaded to their plant from some of the other gatherers and processors, and so that's a good solid improvement that should carry through into the spring months. Some updates on some of the other plant activity. Some of the big plants are on schedule and on track, although it looks like Little Missouri 4 could be slipping a little bit again. And so we'll have to watch that one. I think that's the next one that was supposed to come online. And so we'll watch that one, but there's a lot of gas processing capacity coming on this year. Our problem area continues to be on Fort Berthold, capturing both the fee and the truss gas there. That is lagging far behind the rest of the state. And the plans are, it's just slow. It's just very, very difficult to build those gathering systems. One thing I can talk about there, and I won't spend much time on the federal front, but we're continuing to have conversations with the BLM on the Industrial Commission taking over gas capture regulation on federal lands outside of Fort Berthold. And I think we're getting very, very close to having an agreement. The solicitor's office in Washington, D.C. has actually signed off on almost all the changes. So we're very, very close there. Finally, just touching on crude markets, you can see from the graphs or the charts that I include that crude oil inventories in North America or in the United States are slightly above normal, but really not all that far. And inventories should be building this time of year because summer driving season's not far off. They are not. They're flat or declining a little bit, but there's plenty of crude oil in storage to take care of the summer driving season. And on the world front, pretty much in line. The IEA projections haven't changed in terms of the balance of production and demand. And the IEA just came out, I think, today with an announcement that OPEC cuts are roughly equal to the potential loss of Venezuela production. So should Venezuela go down completely, the recent cuts that OPEC made in the December timeframe could actually make up for that. So there is crude production capacity in the world to absorb that. So not looking at any big price impacts from Venezuelan crude going offline. So that's my prepared remarks. We're off to a great start for 2019.
Perfect. Any questions in the room?
When do you expect the new BLM regulation or the start, and how is that different? You think of what it's going to be.
So our target is still April 1. I'm not sure we'll get there. We talked about kind of a major hurdle we have to get over yesterday, and that is there are parts of the BLM rules that will still apply, and then in each one of those cases there's a transition. We have to work out so it's clear to industry which BLM rules apply when, and when do the NDIC rules kick in. So that's really the final discussion that we have to have, so we make it clear in the agreement. But we're still shooting for April 1. I think it's going to slip 2 weeks to a month from there. But there was a second part to your question, Amy.
Will it change, or and what will really change?
Right. So the question was, what really changes when the Industrial Commission takes that over? And BLM really only, the significant change is there won't be limits, hard limits on flaring or time periods for flaring. There will only be the imposition of royalties on flared gas if the Industrial Commission deems it as flared outside our rules. So again, part of working that out is at what point in our chain do we consider it outside our rules? So for example, it would be if a company should have production restrictions levied against them on a particular well, then it would be outside our rules. So what's really going to change is any hard limits or time limits on flaring on federal wells will go away, and it will just be the imposition of royalties on wells that the NDIC would impose a production restriction on, or that would require a production restriction even if it's producing less than, like we have that 100 barrel a day and 200 barrel a day limit. Even if it's producing less than that, it's going to have to pay royalties on the flared gas. So not a huge change, although I think it's going to be more consistent and more understandable for operators, because there won't be multiple volume limits or time limits. It'll just be, okay, yeah, we have to pay royalties on this gas now for this month, for this time period. So yeah.
I do have one question just related to maybe how the Bakken is or isn't unique in gas growth outpacing oil growth. And if you can maybe talk a little bit about why that's happening, if it's geological, if it's related to storage and capture, or the reasoning behind that growth.
Yeah, so that's a great question. And based on what I know about the other shale plays, the Bakken is unique in that in all of those other shale plays, to the best of my knowledge, the gas and oil have been growing together. The primary reason in the Bakken has been the focus of the 65 rigs and the 105 completions a month being in the more gassy part of the reservoir. So the Bakken's a little bit unique in that the depth of the oil reservoir varies a lot. from about 8,000 to 11,000 feet in depth. And at those deeper depths in the center of the basin where the most productive wells are, there's a lot more gas associated with the oil. So I think we are experiencing a bigger difference in gas versus oil growth than the other plays. And it's because the best geology, the best productivity is in the gaseous part.
Any other questions for Lynn?
Thank you.
All right, we'll go Justin. Do you want to hand me that remote?
Oh, this thing?
Nope, remote.
No.
There you go. Thanks. Oh, didn't even look behind myself. All right, go ahead.
Oh, okay, perfect. Well, good afternoon, everyone. Justin Kringsted, Director of the North Dakota Pipeline Authority. I will get right into the crude oil production side before we hit on the gas topics. Just a quick update. Obviously, you heard from the 2019 numbers. We do now have exit 2018 numbers for the U.S. Williston Basin, right at about 1.46 million barrels per day for the U.S., North Dakota, Eastern Montana, and South Dakota production. Again, those are all the barrels that need to be transported using the pipeline and rail infrastructure here in the region. Month-over-month changes, Lynn had covered that. Very consistent December to January on the crude oil side, and then again, another significant growth month on the natural gas side. Not a record number by any means, but a very solid month-over-month growth for natural gas in the region. We look at slide 5, there were a couple changes on this graphic. Again, pipeline export continues to be a dominant mode of transportation out of the region. I will touch on them here in just a few moments about what's happening from a pricing perspective and what's happening between the U.S. and Canada. That was probably likely where the biggest shift was month-over-month from December to January. You notice on slide 6 some of that history, slight uptick again in that market share on pipeline movements out of the region, and a decrease not only in crude by rail market share, but also in the amount of volume being trucked north into Canada. As Lynn alluded to earlier, we did see, especially late 2018, very, very steep discounts in the Canadian markets for crude oil, and likely is one of the drivers as to why we were seeing less barrels moving north into Canada, trying to avoid participating in that type of market scenario. So on slide 7, when we look at the estimate for crude by rail out of the region, a slight decrease in the month of January. Again, not a lot had changed in December to January when we look at, say, the Brent WTI or some of the other indicators, but primarily in January, some of the traditional pipeline markets in the Midwest saw significant price improvements that likely drew some additional barrels back off of the rail network to some of the more traditional pipeline Midwest PADD 2 refining complexes that just weren't as attractive in, say, November or December. Those destinations for crude by rail out of the region continues to be dominated by the Pacific Northwest. Just over 60% of North Dakota's crude by rail moving in that direction. The remainder heading either to the East Coast, and then still about 10% heading down towards the Gulf Coast refineries. Look at pricing for December. Some significant differences when you look at PADD 2. December was one of the deepest discount periods for PADD 2. High 20s of a discount between, say, PADD 1 and PADD 2. So again, those barrels, at least for December, which is the most recent data we have, barrels, again, trying to avoid that PADD 2 refining complexes, get to the coastal destinations, and try and receive the highest value they could for that crude oil. January, until those numbers become public, it's likely we're going to see that gap start to close again between PADD 2 and those coastal PADD 1, 3, and 5 regions. Where we sit today, again, just over $8 price spread Brent WTI. that is high enough to continue to incentivize crude by rail movements out of North Dakota. So I don't anticipate when the March numbers come out, we see any major shifts because of that market driver. And then slide 11, this was that truck traffic north and south of the border, as well as any rail movements that are being captured through these numbers coming south into and through North Dakota. You'll notice some very interesting trends here in the exports. I'm still a little leery about some of those late super high numbers that we were seeing for exports, whether or not there's some reporting things happening at the federal level that may be influencing those numbers. But by and large, coming into December, January, a significant decrease in the amount of truck traffic going north. Again, my logic behind that would be that, again, barrels are trying to avoid participating in those highly discounted markets, trying to stay on the U.S. side of the border and heading towards, again, either one of the pipeline or rail market options directly out of North Dakota. On the natural gas front, identical numbers, December to January, as far as the amount of gas being captured from connected versus unconnected wells. No changes in this graphic other than continuing to see the overall natural gas production curve continue to grow. And then slide 14, some additional good news here. The new wells selling gas did significantly outpace the new wells coming online for natural gas production. And so as we hit some of these winter months, January, February, March, when we may see depressed numbers for well completions, it likely could be a good time for some gas connections and some catch-up work to be done on the natural gas gathering front. Again, getting it connected, but then also that's just the first step. You need to have enough pipeline and plant capacity behind that connection, which is really where the challenge then continues to be. So again, this is an important thing to continue to watch, but until we have additional plant capacity coming online in the region, it's not going to be the only metric that we need to continue to keep our eyes on. When we look at the catch-up period in the short term, again, we're anticipating it won't be until late 2019, early 2020 before plant capacity catches up with the production expectations for growth here in North Dakota. And then long term, again, we're still looking at that early 2020s for additional infrastructure needs on the processing capacity here in North Dakota. And that time frame is getting close. We'll likely start to hear announcements and decisions being made by companies of what that next batch of plant capacity is going to look like. So we'll continue to keep everyone updated on that front as those projects start to go public. So with that, I'd be glad to answer any questions from anyone on any of these topics.
Any questions for Justin?
So no new announcements yet. I'm told to hear soon.
No new announcements yet. They'll likely probably within the next 3 to 6 months start hearing more about those.
Right, nothing on my end. So.
Perfect. Well, thank you.
Thank you.